Another day, another all-time closing high for the Nasdaq Composite. We also saw all-time intraday highs on the S&P 500 and the Dow Jones Industrial Average, but both of those indices did close a little bit lower here today. In fact, they were showing some somewhat bearish candlestick formations at the end of the session, so we'll have to see if that leads us to a little bit of a pullback in the short term. Those two indices were weighed down by some retailing shares, in particular Home Depot and Kohl's really struggled after releasing their earnings. So we'll take a look at all that to see how it affects our posture. We'll then get into our trade application example where I found an internet stock that's really gotten quite oversold in recent weeks and might be setting up for an interesting reversion to the mean type of a trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 19th, 2019. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. I would encourage you to follow me there. My handle is @BrandonVanZee, and thank you to everybody who clicks like and retweet on these Market Outlook related posts there for us. Lastly, we have a presence on Facebook. Please join our group that's embedded in the logo in front of you. All right, let's go ahead and jump into the charts. As you can see, I've got chart 4B pulled up here in front of us. For those of you that are premium members of Market Scholars, you're welcome to follow along with these various charts. This particular chart is just going to show us a foregrid of the major indices here in the United States and will give us a sense of whether our postures are bullish or bearish according to the market forecast intermediate term line. Remember, the market forecast is a technical indicator that you can find over on the Thinkorswim platform, and it has several different colored lines within it. Unless we tell you otherwise, our default mode in these presentations is to discuss it from an intermediate time period. And so as it stands right now, the S&P 500, you can see that the green line is firmly entrenched in that upper reversal zone, as it is the case over here with the Dow Jones, as is the case with the Nasdaq Composite, as is the case with the Russell 2000. So despite today's pullback in the Dow Jones, you can see what that looked like right here, and the S&P 500 right here, our intermediate posture remains bullish. Now, having said that, one of the things that I'm sure you've heard David and I discuss multiple times over recent weeks is we're getting a little bit long in the tooth from a near-term run perspective. And what we mean by that is this blue line here on the market forecast rarely stays above 50 as long as it has here more recently. We're approaching 30 days now where the blue near-term line has been above 50. Typically that tops out well before then. So it's not completely unheard of. There's been times in the past where it's been a little bit more than 40, but nonetheless, this is well more than average. And so we've been kind of a little bit more on alert for any potential signs of a really short-term pullback. Now, just because we might expect a short-term pullback does not mean we are bearish. We fully expect the stock market to remain strong into the end of the year, but most markets don't go straight up, and every market needs a little bit of time to breathe, and we have to try to figure out when those times will be. A couple things that I wanted to point out with our candles here today. With the S&P 500, we were down 0.06% today. You can see what that kind of looks like on the chart right there. Some of you might identify that as looking somewhat like a hanging man. Remember, a hanging man candle and a hammer candle look fairly similar to one another. What defines them and makes them different is whether the candles are placed at a point of resistance or a point of support on the chart. Now, obviously, this is a high area up here, so you're probably not going to put it at a support level. This might very well end up being a resistance area. It's probably too early to make that claim, but that's what we'd be looking at. Now, some of you might also say that that candle doesn't look like it has a long lower shadow that would be long enough to constitute a hanging man, and that might be accurate as well. But the psychology of that candle is there, where it looked like we were going to go up to a new all-time high today, which we did on an intraday basis, but the bulls came in at the end of the day and kind of rolled over, and the bears ended up winning the day with a red candle there. The Dow looks a little bit worse than that. Here it's a little bit more aggressive looking candle where it is filled in red for the most part there, where we do have a bearish engulfing candle on the Dow. It was a little bit more of a significant pullback. You can see the Dow was down 0.36% today. Again, a big reason behind that was Home Depot is one of the 30 stocks on the Dow, and it really struggled today after issuing some lousy guidance going forward. And so that pressured the Dow more than the other indices. So that's the one that is maybe a bit more concerning from that perspective in the short term, where you have that possibility of a pullback of sorts that could be on the horizon. We'll have to wait and see whether that develops or not. But the candles today didn't really do us any favor in terms of continuing this really strong near-term run that we've been in. Now, one thing that is on the other side of the coin, remember, none of the analysis will ever be remotely close to perfect when we're dealing with technical analysis. A lot of it is in the eye of the beholder. One of the things that you could make the claim of on the other side of the argument would be that we do have what's known as bullish intermediate confirmation signals on those two indices that I mentioned up at the top, the S&P 500 and the Dow Jones Industrial Average. Now remember, on the bullish intermediate confirmation signals, what we're looking for is for the green line to simply be bullish. And remember, the green line can be bullish by either being in the upper reversal zone, as it is right now, or simply traveling higher, as it was back here in October. That green line was rising between 20 and 80, and therefore we would have considered it bullish there as well. So one of those two things has to exist, either the green line in the upper reversal zone or the green line simply rising between 20 and 80. Once you can make that check mark, then the second question you ask yourself is the red momentum line in the lower reversal zone? In that particular case, you can see that it is. Remember, the lower reversal zone on the market forecast indicator is a little bit different than the stochastics. On the market forecast, the lower reversal zone is at 20. So you can see right here in the red label, it says momentum is at 18 and falling, and so that's clearly below 20. And that is the case over here with the Dow Jones Industrial Average as well. Dow Jones shows the red momentum line at 9 and falling. Now, before we get too excited about the prospects of a buy the dips type of a moment here, which is oftentimes what these bullish intermediate confirmation signals are used for, remember that there are various ways to try to determine whether the signals are more ideal or not. One of the things that we look for is if the blue line is between 20 and 50. Notice that the blue line on the Dow Jones is up here at about 67, and the blue line on the S&P 500 is actually still in the upper reversal zone at 81. And that makes sense as well if you're just looking at the chart, right? You look at the Dow Jones here, it's a more significant pullback. What we experienced today, you just see that through the candle itself, whereas we didn't really have much of a pullback at all on the S&P 500. Sure, there was a tiny drawdown, but it's nothing to get overly excited about. So remember, that blue line is telling us whether we've had a nice healthy inhale or exhale along the way. And so far, it's just really not giving us that information. So the point is, yes, we have bullish intermediate confirmation signals on the S&P 500 and the Dow Jones Industrial Average, but neither of them would be considered ideal setups, and we might need a little bit more of an exhale here from these markets before setting up and gearing up for another run higher. So that's what we're kind of looking at right there. Before we move on, I mentioned the intro. NASDAQ was the only one that can make the claim that it hit not only a yearly high today, but an all-time high. And not only that, but we closed at that high. In other words, it wasn't just an intraday high like we see up here and right here, because we closed higher on the Nasdaq Composite by 0.24%. That was the only index here of these four that had an all-time closing high here today. And then Russell 2000 probably deserves a mention as well. It actually was the best performer of these four today. It was up 0.37%, but its chart does look quite a bit different than some of the others. You can see here that it had a little bit sharper of a pullback here in the last couple of weeks, as the other markets largely just coasted a bit higher. And so with this bounce today, sure, it was a little bit sharper back up there, but we're still not to that high that we pushed to here just back in November, let alone where we were trading back in July. So the Russell 2000 does kind of stand out as being different than these other charts on the board. The other three kind of have been, largely traveling in unison with one another for much of the last, several months to years, whereas the Russell 2000 small cap universe does trade a little bit differently than some of the others. But today's move was a fairly substantial move, higher there, up 0.37%, and a nice close above the high of the low day if you use yesterday as kind of your bogey there. Let's go ahead and take a look at another chart setup now. In this particular case, let's go ahead and do the three green arrows analysis here. This will be chart 4D for those of you that are premium members following along at home. As it stands right now, we have 2 out of the 3 charts with 3 green arrows. It's a little bit suspicious, I might suggest, because the NASDAQ composite was the one that had the strongest close today, but that's actually one that does not have 3 green arrows right now because we still have that red arrow as a thorn in our side, so to speak, there with the MACD histogram. So momentum wasn't quite as strong here recently as it was when it first started kicking into gear back here in October. The areas that do have 3 green arrows up here with the S&P 500 and the Dow Jones were the 2 areas that actually pulled back in price here today. So we'll keep our eye on that situation. Especially with the Dow, you can see that that has had 3 green arrows for a very long time. It's had 3 green arrows going on the way back here since October 25th. And you usually don't have it, especially on the daily chart, for us to go back that long without having one of those green arrows turn into a red arrow. And just to catch everybody up to speed, the arrows that I'm referring to here, most of you are aware of this because you were with David and I in a prior life at our prior employer, but for the rest of you, the 3 green arrows system is using 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastics indicator, and basically looking at whether they would be considered bullish or bearish at this moment in time and trying to line those up in the general areas to give us a sense whether this is a stronger or a weaker time to be a trend trader. So right now I'd say the signals are mixed from that perspective. We've had a really healthy run to the upside, but we're in a kind of a little bit of a holding pattern for most of these charts where we've been just kind of gradually moving sideways as opposed to a robust trend move higher like we saw back in October. All right, moving right along now to a longer term view. Let's look at chart 4C, and this will be our 1040 crossover method. As you can see, the only chart that has had a recent change is down below here, the Russell 2000. You saw that background color go from pink to green about 3 weeks ago, and that was when we saw a bullish crossover on the 1040 crossover method. And remember, on this chart, it's a 3-year weekly candle chart. So the orange line is a 10-week moving average, and the blue line is a 40-week moving average. That's when that crossover occurred about 3 or 4 weeks ago. The other charts have had a bullish posture going all the way back since late winter, early spring of this year, and have continued to be bullish along the way. So for the most part, those of you that look at this longer term philosophy where you're not, trying to be the hyperactive trader out there and rather just trying to get a sense of establishing basic trends, this has been a reasonably strong approach to the markets in 2019, which are quietly shaping up to be one of the better performance years the markets have experienced, at least in our current generation. I know it doesn't get talked about a lot, and part of it is perspective. We have to remember that late 2018 was a massive drawdown in the stock market, so that meant that by the time January 1st hit of this year, we started at a quite low place, relatively speaking, and so that did assist the returns that we've seen so far on a year-to-date basis. But nonetheless, it has been a very strong year for traders and folks that are willing to be bullish on the markets. Remember, if that is you, pat yourself on the back, congratulate yourself, because there's a lot of haters out there. There's a lot of people that just absolutely refuse to get involved in the stock market because their mind is playing tricks on them. As always, take a look at the charts. If the charts are trending higher, don't question it. Assume that the trend is your friend, and right now that is certainly the case. All right, let's go ahead and now take a look at some other charts. Let's do some 12 grid analysis here, starting with chart 5A. This will be our asset class 12 grid, and this will give us a sense of some asset classes, stocks, bonds, commodities, etc., to kind of get us a lay of the land as far as where markets are shaping up. So as it stands, you can see that we have a number of green charts on the board. Some of them are a darker shade of green, some of them are a lighter shade of green. Remember, what makes that difference is whether the intermediate line on the market forecast is considered strongly bullish or weakly bullish. If the intermediate line is simply in the upper reversal zone above 80, that's always considered strongly bullish. Or if it's simply traveling higher between 50 and 80, we'd also consider that strongly bullish. If the intermediate line is rising between 20 and 50, then that's just simply considered weakly bullish. So some instances of bullishness, but not enough to give us a sense that it's a robust move at that point quite yet. So we have kind of a mix from that perspective, but most of you watching this video probably are interested in the stock markets, and so you'll be happy to know that our stock market posture in the United States is still strongly bullish despite today's slight pullback in the S&P 500. The intermediate line is way up there at 98. Remember, that can't even go above 100. So that gives you a sense of how big of a move we've had here recently. And again, that doesn't mean that this stock market will continue to go up every single day for the next several months. At some point, we'll have a pullback. But it is also true that you have to set your expectations there, your assumptions. Some of you might assume that every little piece of bad news is going to lead to an immediate bear market. That's not my belief, but some people think that way. The way that I'm thinking about this is we're in a strong market. We're overdue for a little bit of a pullback. Once we get that small pullback, I'm expecting a higher low to be formed and eventually go to a higher high. And I'm expecting new all-time highs by the end of this year. And so, don't get overboard with the idea of, I need to put on a whole bunch of bearish trades here because we're overdue for a pullback, because that can bite you pretty hard if you're not in and out quick enough on a situation like that as well. So right now, our intermediate trend remains strongly bullish in the United States. Here on EFA, we also have a dark green background, and EFA, you'll recall, is the foreign stock markets from a developed perspective. Interestingly enough, we do have the emerging markets with a weakly bearish posture. Remember, that's not a strongly bearish posture. We don't get to a strongly bearish posture until the intermediate line is at 50 and falling. Right now, it's only at 68 and falling. So just be aware of that. Again, I'm not going to make too much of that because the chart is still above a rising moving average. So I'm happy to know and be aware of the fact that, hey, there's some underlying bearishness creeping into that particular chart. But until that trend starts changing or major support levels are being broken, I'm just kind of viewing that as more noise than anything else right now. In terms of some of the other key areas of the market that you'll want to be aware of, Treasury yields did fall here today. Now note that makes it 5 out of the last 6 sessions interest rates have fallen, at least if you're looking at the 10-year. And so that's kind of interesting because a lot of those REITs and utilities for a while were really getting roughed up. Remember, REITs and utilities are very interest rate sensitive. And when interest rates go up, like they shot up right here from November 1st to November 7th or whatever that was, utilities and REITs really struggled as a result. In fact, this will be a good kind of Rorschach test right above it here. You can see that the REIT index that we're using in this case, VNQ, was going down significantly at this time on the chart right below it where interest rates were going up. Well, now look at what's happening. Now that interest rates have fallen 5 out of the last 6 sessions, look at what's happened to REITs. It's gone up 5 sessions in a row ever since putting in that oversold cluster signal that we identified there, about a week and a half ago or whenever that was. So now that we're back up at these levels, it's kind of do or die time. Now, it depends upon your mindset. I personally am kind of thinking that the REITs are more of a sell right here than a buy. Now, again, I don't know the future any more than you do, but with my assumptions of us being in a strong general stock market, and that is my expectation by year end, hitting new all-time highs on the stock market, that's generally a risk-on environment. And if that were to unfold, my expectations would be that interest rate expectations would start ratcheting up a little bit. I'm not expecting them to go dramatically higher, but generally speaking, if the economy is found to be on strong footing, it is expected that interest rates are more likely to go up than down in an effort to potentially try to cool down that very hot economy. And if that's the case, then it would be my indirect assumption that real estate investment trusts would struggle as a result of that. So whether that unfolds or not is anybody's guess, but I'm merely pointing it out because some of you have patiently been waiting for a snapback rally in the REITs in order to put on some bearish trades. And perhaps this is a moment now that we're right back up here to this moving average where you can put on some bear call spreads or something along those lines. It's a lot better doing it here than doing it back here when it was an oversold condition. Okay, and likewise, some of you might be betting that interest rates will start rising from here because they're now sitting on that moving average, which can be used as kind of a support bounce area to the upside here, a support bounce to the downside here on REITs. So bounce up on yields, bounce down on REITs would be one way to think about the market potential here in the near term. All right, let's go ahead and take a look at another 12 grid. In this case, let's go to the U.S. sectors 12 grid. All right, and this is chart 5C. And this will give us a sense of kind of what's been going on here in the United States from a market cap weighted perspective. And it seems like that conversation has been coming up a bit more often here recently because of some odd behavior in some key stocks. Discretionary does come to mind. You'll notice over here on the left-hand side, it appears that discretionary is struggling right now. A lot of that is as a result of Amazon. Remember, Amazon makes up a full 1/3 of the discretionary ETF XLY. Today, you actually saw others kind of join it, so be aware of that. Prior to today, I wasn't as concerned about discretionary. I may be a little bit more concerned right now just because we did see Home Depot and we did see Kohl's come out and kind of stink up the joint today when it comes to their earnings announcement. So if we start seeing a little bit more of that struggle with those other retailers beyond Amazon, then yeah, we might have some problems there in discretionary. Right now, you can see that we've basically just been tracking sideways. We're kind of in the middle of the 3-month range as it stands here currently. Energy was down today as well. Remember, energy, this particular ETF, XLE, is controlled largely by just 2 stocks, ExxonMobil and Chevron. And so as they go, this particular ETF will go. Sometimes that's good, by the way. Sometimes it's bad. Earlier this year, when energy was really struggling, ExxonMobil and Chevron tend to hold up a bit better in the down oil markets. On the other hand, they're not the big, robust names that will, truly outperform to the upside if oil prices start spiking. So it does work both ways, but it kind of balances it out right there. But do know that both of those stocks were down today, and so it's not a big surprise to see XLE struggle a little bit here today as well. Kind of mentioned the REITs already and how they're kind of at an important spot on the chart right now. You can see that XLRE is just a hair below that falling 30-day moving average. And so, again, that might be an area where you're thinking about shorting some of those stocks. Over here with utilities, it's much the same. Remember, utilities and REITs oftentimes look very similar to one another because of how they react to interest rate movements. And so utilities were actually down 0.25% today. So they went up and touched their moving average yesterday. It already rejected it and started pushing it down already today. So you'll be curious to see where that particular move takes us. Otherwise, a number of the other areas are holding up reasonably well. Healthcare hit another nice move here today. It was up 0.68%. We also saw financials do pretty well here today, up 0.2%. So those are a couple of the areas that have been holding up a bit better than others. In fact, let me come on over here to the internet briefly and show you the sector selector. Remember, I put this together on Friday, so this isn't entirely up to date to the moment, but at least gives us a nice general view of how the various sectors are trending. And some of the bigger news was industrials, financials stayed number 1 and number 2, but we did have technology and healthcare start gearing it up to the upside here nicely. And so technology is a story that is going beyond Apple and Microsoft all of a sudden. And that was kind of the knock on technology just a few weeks back. There was significant evidence that suggested a lot of technology companies were not really kicking it into high gear, but it was mostly being led higher by Apple and Microsoft, which on a market cap weighted basis, something like XLK is going to recognize. My rankings right here actually use an equal weighted basis, so that's where you see some differences from time to time. But anyway, in the last week or two, we've actually seen those soldiers within technology start to join the generals, if you were to think of Microsoft and Apple as the generals. Now you're starting to see significant movements with the semiconductors, if you lift up the hood. And that really helps because the semiconductors is one of the bigger industry groups within the technology sector. So there have been breadth improvements within the technology sector itself. And as I mentioned there, healthcare also had a nice little pop higher. Also, one thing I wanted to point out, this isn't a big deal, but I did discuss this in my Monday top-down trend trading class with my premium students. Wanted to point it out here too, just to make you aware of it. Again, I don't want, this is not like a go sell everything type of a moment or anything like that. In fact, that should never be the case. Remember, stocks have a much greater ability to rise over time than to fall. And therefore, very few people should ever just make the decision, I'm going 100% to cash. At least that's not my philosophy. But there are certainly times where you can trade around positions, and sometimes you can be more bearish than other times. One thing I wanted to point out was that from a market breadth perspective, one of the things I track is new highs and new lows. And last week, we actually saw a slight reduction in the new highs. We went from 185 the prior week on November 8th down to 135 on November 15th. So that's a loss of 50 names that were on this graphic the week before that did not hit highs this past week. So from a breadth perspective, that's a little bit of a negative sign there. I don't think a lot of people were aware of that because last week was actually a decent week from just a price performance perspective. It wasn't like we had a big leg lower in the stock market, but just simply from the underlying components, we are seeing a little bit of slippage up there at the top. So we want to keep our eye on that. We also saw 3 additional new lows beyond what we saw the prior week there as well. So a slight worsening of a market breadth perspective, at least if you're using new highs and new lows. And remember, this particular portion of the sector selector is usually only made available to premium members of Market Scholars. So feel free to check out our packages and our subscriptions if you're interested in receiving this information each and every week. Also, while I'm over here on the internet, wanted to say thank you to those of you that clicked like for me the last time I did the Market Outlook video on Twitter. You can see 112 of you clicked like for me. We really appreciate that. Remember, it takes 2 or 3 hours all in with all the time that goes into the researching and the recording, the editing, the sending out of notifications, the updating of social media, all that kind of stuff takes time. And we don't get paid to do this, right? So we do these videos to promote what we do from a premium side, but these YouTube videos here are made free for all of you. So if you guys could help support us by clicking like on Twitter, it helps get information out to a wider audience than we'd be able to on our own. So we kind of look at it as a little bit of a trade-off there. If you get value out of these videos, please click like for us every single day, and we'll continue to do our best to get these videos done for you every single day as well. All right, let's go ahead and now talk about our trade application example here for the day. And I mentioned in the intro that it was an internet-related stock that had been oversold here recently. So let me tell you here what I'm looking at. Let's go over here to chart 4A for this. And the stock I want to pull up is Twitter. Speaking of Twitter, here's the stock, not necessarily the service. And you can see Twitter's really fallen out of bed here recently. I don't talk about Twitter a whole lot myself from an investment perspective because it doesn't pay a dividend. Many of you know I'm more of a dividend investor at heart. And those stocks that I trade that are beyond dividends usually are profitable. And Twitter has more recently become profitable. It wasn't initially after its IPO, but more recently it has actually started turning profits, which is a nice thing if you're looking to enter into a business owner mindset like I typically try to teach my students in my premium classes. And so one thing that's catching my eye with Twitter here after this big gap down on their earnings announcement here where it really disappointed Wall Street is that it's it's at an interesting junction if you're to look back a little bit further. So let me show you something. First of all, while we're on this daily chart, do recognize that we've had a bunch of oversold cluster signals on a daily candle basis over here at the end of October, beginning of November. But now when I flip it to a different time period, let's use 3-year weekly in this case, you can see that it looks a little bit different, right? We're looking at a much longer period of time in this case. And you can see something that really stood out to me as of Friday. With these being weekly candles, you don't get the cluster signals until Friday. And so as of Friday's close, we actually got a weekly oversold cluster signal on Twitter for the very first time since going all the way back to over here in October of 2018. So in other words, more than a year ago. And remember, those cluster signals occur when the green, the blue, and the red lines all are in the low reversal zone on the same bar. And in this case, again, these are weekly bars that we're dealing with. You can also see that back here, after it was first launched, after its IPO, this is way back in 2017, in a lot of those candles, we had oversold cluster signals as well. So the point is, as I look at these oversold cluster signals on a weekly candle chart, many of them show a very strong area of support, or they're kind of a precursor to a bounce of sorts, right? Over here, this stock was trading at about $15 or so when it was putting in these cluster signals, and then rallied strongly all the way up here to about $18 or $19 after their earnings announcement over here in that first set of clusters. Then we fast forward to over here when we got this one in October of last year. And at that time, the stock was trading at around, I don't know, $28, $29, somewhere thereabouts. And really, you only had one more candle lower, and that was the very next week. After that, it basically surged all the way up here to 35. And that brings us to where we're at right now. Again, this is a speculative kind of reversion to the mean type of a trade, because clearly the trend is against this chart right now, as it was back here. Notice the deep shade of pink that was occurring back here and the deep shade of pink that was occurring back here. Remember, if you're going to get an oversold cluster signal on a weekly candle chart, there's almost a guarantee that you're going to have a deep shade of pink, dark background color there, suggesting that the current trend is quite bearish. So we know that. If you have a set of eyes, you can look at this chart and you can say, yeah, this is a very bearish trend. But there gets to be a time when something gets too bearish, and there might be an opportunity to take the other side of the trade. And I'm almost wondering if this is a moment like that for Twitter. As you can see, we've stayed in this range over the last 2 years, where we've looked at about 45 on the high end a couple of times, and we've looked at about 28 or 29 about 3 times over the last couple of years. And it looks right now like we're starting to bounce off of that candle from last week. Again, it's a dangerous trade, but it's an idea out there for those of you that are willing to be so bold. What I think I'll do here in this particular case is, rather than just buy the stock outright, I'm going to do a bullish options trade known as selling puts. Now, selling puts is a way for you to say, I'm interested in taking a long position in a stock, but I'd rather buy it at a cheaper price than where it's trading right now. If that does not happen, then at least I still get a partying gift of the credit that you receive when you sell that put to begin with. And so let me explain. If I come on over here to the trade tab and I go out to the January contracts with 59 days until expiration, the contracts I'm going to focus on are these 26 strike puts that you see right here. They're currently going for a bid of 30 cents and an ask of 32 cents. So that's just above a 1% return on risk, as you can see here, which is a cutoff that I use quite a bit for my longer term classes. So what you're asking yourself is, would you be a willing buyer of Twitter at $26? Now, going back over here to the chart, you look at where 26 is on the chart. It's approximately, if I can get my mouse on it, it's right in that general vicinity right there. Now, the point that I'm trying to make here is, you'll notice as you kind of track that crosshairs across the chart back to those prior lows, that if you were forced to buy Twitter at 26, you would be buying it at a slightly lower cost basis than where this stock was trading back here And back here on this kind of set of double bottoms that we have right here, you can see that the low price on this candle was 26.19. The low price on this candle was 26.26. By selling the $26 put, you're basically putting yourself on the line for being willing to buy at least 100 shares of Twitter at $26 if it does get down there. If it doesn't, and let's say that this cluster signal works out nicely and this stock starts bouncing higher, then you'll simply get to keep that premium that you took in when you sold those puts to begin with. So, it's a more aggressive trade setup because of the trend that's against this stock right now, but you do get a little bit more wiggle room in how I'm setting up the sold put trade. For those of you that want to be even more aggressive, of course, you could buy calls to the upside. If you think this is going to work out, there's probably a decent chance this thing could roar higher and give you some nice returns there as well. But that would be a much more aggressive mentality than selling puts. So we're just going to keep it nice and simple, sell some puts on this and see if it can work out for us. So I'm going to come over here to the trade tab. I'm going to click on the bid price of 30 cents here currently. I'm actually going to change this to, let's do 4 contracts instead of just 1, and I'll leave that at 30 cents to see if we can get filled first thing in the morning. Clicking on confirm and send, and everything looks good there, so I'll ship it off and see if we can get filled. All right, well, thank you for joining me here yet again. It's an interesting day in the market where we did have continued bullishness, especially in the morning. But by the afternoon, we did see some of those markets like the S&P 500 and the Dow Jones struggle a little bit, especially because of those retailers. So we'll see where that takes us. Right now, the bullish posture remains intact. In fact, we've got bullish intermediate confirmation signals on a couple of those indices as well. But as we've been stating lately, we are more than overdue for a little bit of a short-term pullback. So we'll see if that happens at any time in the coming sessions. As always, I appreciate those of you that click like on Twitter if you got value out of this commentary here tonight, and I'll look forward to seeing you tomorrow as well. Take care, everybody. Bye-bye.